Another day and another bailout. Better get used to it because there's a lot more trillions coming. So, on Monday, the Fed, when Congress was inept, Congress is using the media to throw stones back and forth with each other. There's a number of different articles out that I've seen. There was a tweet rant by a Democrat journalist, this guy Matt Stoller, who was blasting the GOP, the rhinos, the neocons, relentlessly about unchecked bailouts and who the money was going to go to. And then the Republicans were doing very similar, using their own friends in the media, just back and forth, back and forth. Meanwhile, the Fed was just cranking it out. We're just getting to theater of the absurd here. So we finally got to the Fed's official balance sheet numbers out, and in only a week, the Fed's official balance sheet is up absolutely enormously. It is up, let me pull this up here, on the Fed website now, finally got it updated. It is up over $300 billion in only a week. The Fed's official balance sheet is now at $4.668212 trillion, which is now more than the 2008 and 2009 financial crisis. And we're just getting started because of all the MMQE, all that money that's going to be going in checks, which Kyle Bass has said he's estimated in the last week or two. Kyle Bass, hedge fund manager, hopefully I'll get him on a podcast in the near future. I've been talking to him about that. We'll try to get him hopefully in the next month or two. He has been saying that the Fed will print $6 trillion in the near future. So he thinks, to cover the gap for the economy restarting, he thinks $6 trillion. Luke Groman from Forest for the Trees said on Macro Voices, he said $47 trillion. Not sure the Fed needs to do $47 trillion right away. I mean, it wouldn't surprise me if they eventually do that. I mean, nothing really surprises me anymore. But we're in theater of the absurd, Twilight Zone territory now, where literally anything can happen. Rules changes can happen daily. We could see accounting laws changed. We could see new garbage bought. And speaking of garbage, let me let me bring on the hype man, Larry Kudlow, who explains the purchasing that's going to go on, and then I'll talk about the PRs officially from the Federal Reserve. Let's hear in Larry Kudlow's own words from earlier on Monday on Fox News about what the Fed's going to be buying.
Again, after the Fed's bold move this morning, dealing with the coronavirus crisis. Joining us now, Larry Kudlow. He is, of course, a top White House economic advisor. Larry, we got limited time, but thanks for coming in, sir.
Thank you. Appreciate it.
Let's do a lightning round. The Fed move. The president's been pushing the Fed to act. They've acted again this morning, and yet the markets are not happy.
Well, I think the markets aren't happy because the entire package has not been done. I mean, we've got to get this package to pour liquidity and cash and make more credit available. Here's a key point, Ed. Inside this package, there's a special Treasury fund. It's called the Exchange Stabilization Fund. We're raising that to $500 billion from 75. That allows the Federal Reserve to come in and make loans against that equity. In other words, that's the Treasury's equity, and the Federal Reserve, and they've extended, the Fed's doing a great job, they've extended their credit facilities, just think of it as Fed loans, to small and medium-sized businesses now. They're looking at asset-backed stuff for credit cards and student loans and other borrowing mechanisms. This is absolutely essential, and I think Wall Street and the stock markets want to see this huge Fed credit liquidity backstop, and the core of it, the equity piece, is in the legislation, which may or may not be voted on.
So that's the Fed piece. Now the stimulus piece that you've teed us up for, which is that the markets, more importantly workers around America, as you know, want action from the Senate. They haven't gotten it yet. Democrats blocked that vote last night. Let me play devil's advocate. Chuck Schumer is saying that $500 billion fund that would be at the discretion of the Treasury Secretary, the big sticking point, they say anyway, is that it's a slush fund, they say, for corporations. It won't get to workers, and you don't have strings attached. Your answer, sir.
Well, look, I mean, Senator Schumer should be able to come to an agreement on that. That's the ESF fund that I'm talking about. So the nub of the whole issue, to get the Federal Reserve lending and some other things, it's not a slush fund. Look, that will get money to small and medium-sized businesses, okay? It will also get money to key parts of the economy that are distressed. There's nothing slush about that. It'll all be done transparently. No question about that. But we're going to give, the direct checks to the workers. That's very, very important. We've helped out, people who have to stay at home because of the virus. That's very, very important. We have a loan guarantee program for small businesses. It may take a little more time, but that's very important. We've got direct deposit from the IRS into individual men and women, whatever it is, $3,000 a family. But on this so-called slush fund, I want to be very clear. This is something that is the corner, the keystone. When we get that done, and it will be transparent, the Treasury will run it with the Fed. It will inject liquidity. It's probably, Ed, the fastest way to get liquidity and credit into the economy, into all these sections. I mean, the Fed's opened it up. I'm just going to read it to you. Student loans, automobile loans, credit card loans, small business loans, money market loans, corporate bond. This is what will keep us whole while we hope and pray that the virus flattens out in the weeks ahead.
Larry, I've got about 30 seconds, but big picture. The president tweeted about midnight, we can't let the cure be worse than the problem. He seemed to be talking about, in another week or so, making a decision to try to get the economy back open. Governor Cuomo said much the same a minute ago. He said, we got to plan the pivot, open the valve. How do you do that?
Well, we're going to have to try to do that. We can't shut in the economy. The economic cost to individuals is just too great. So let's see how this thing plays out. More testing is essential, and we're loading up with tests now. That's going to be a big help. But the president is right. The cure can't be worse than the disease, and we're going to have to make some difficult trade-offs. I'm not the I don't want to get ahead of the story. I spoke to the president about this very subject late last evening, so we'll be looking at a number of different things. Let's give it another week.
And you're optimistic you'll get this deal in the Senate today? Real quick answer. Optimistic?
Either today or tomorrow, Ed. I just can't believe that the other side of the aisle won't help us on this. I just can't.
Okay, that's enough. So I think got the point across. He talked about the Exchange Stabilization Fund, which was kind of shocking. And then he talked about student loans, credit cards, subprime auto loans, I think, corporate bonds. It's nuts. The gold market responded violently when the details came out. There was over 100-point swing in the gold market in the last 24 hours. The gold market got down earlier on Monday to $1,486 per ounce, and it got as high a little bit ago at $1,595 an ounce. So a little bit below that right now. The gold market is really worried now that the Fed is going to do even crazier things, stupider things, mostly because of the dollar. The dollar index, also because bond markets and credit markets froze up. Look at all the different bailout facilities, primary dealer bailout facilities, money market bailout facilities, commercial paper bailout facilities, all these different bailout facilities, an alphabet soup of them that have been rolled out. They were brought back from 2008 through 2010. After they took a few years off their back. The dollar index was above 102 earlier on Monday. It is down a little bit, barely. The trade-weighted dollar index, though, was still screaming higher the last time I looked at it. The regular Federal Reserve has it. A website has it. I was sent by a listener a link to that. Now, the Fred website does not have that. The trade-weighted dollar index, that's been discontinued there. And the Fred website finally updated the Fed's official balance sheet. Look, guys, it's only going to get crazier, guys and gals. It's only, because I know I have more female listeners now, it's only going to get crazier and crazier and crazier. People tell me, what the Fed does is already crazy. And I tell them back, it can get a lot crazier. And it is. Just look in the last 10 days. We've had almost a new announcement per day. Another day, another bailout series, right? Welcome to dystopia. So let's put the Fed's official balance sheet growth in some perspective. Since the Fed's quantitative tightening or balance sheet reduction program ended prematurely in the end of August 2019, the Fed's official balance sheet is up now over $900 billion officially at $908,266 million. And just in the last couple weeks, it is up absolutely enormously. Let's see here. Since March 4th, it was only at $4.24 trillion. So it's up over $400 billion in 2 weeks. Well, Yeah. Well, a little under 3 weeks. Little under 3 weeks. So the Fed's official balance sheet is skyrocketing faster. There's going to have to be a lot more. They're going to have to probably buy corporate bonds because there is, I reported on this, really no demand for a lot of these investment-grade corporate bonds. Everyone is worried, very, very worried about the credit ratings downgrades and that doom vortex loop that is coming. The credit ratings downgrades will come. The ratings agencies have been warning about it. They haven't started rapidly downgrading a lot of large publicly traded companies, but that will start. ExxonMobil got one in the last 2 weeks or so, and they were warned about a second one. And they went out and borrowed $8.5 billion, another $8.5 billion more anyways. Welcome to dystopia. So the airlines are supposed to get this bailout, but airlines will be restricted from stock buybacks, issuing dividends, and outlandish salaries for executives under a draft of the new House of Representatives bailout proposal. I would add in there at least for a couple years. Wink, wink, nod, nod. Or there's going to be some type of like exception to the rule. They're going to figure a way around this because that's just how things work nowadays. Okay, so let's get into the details of this bailout. This new bailout. Another day, another bailout. So the Zero Hedge article, I'll read this one, and then I will read the Jim Bianco analysis from Bianco Research. He has his own piece out. I'll read that one too. Coming into Monday, the Fed had a problem. It had already used up half of its entire emergency $700 billion QE5 announced last weekend. Wow, that was fast. Which, together with the plunge in stocks, is why at 8 a.m. on Monday, just as we expected, just as I expected and told you would happen based on Ben Bernanke's 2002 helicopter money speech, because now that we are in a full-blown crisis the last couple weeks, the rules are going to keep changing. The goalposts are going to keep moving. The Fed is constantly watching the dollar. The Fed is constantly watching different markets and waiting to see a reaction if they can knock the dollar index down, if they can get the stock markets to rally. The Fed's going to be looking at these things constantly now. And they will be willing to issue a press release to try to move these things up. Okay, back to the article. Just as we expected, given the political cover they have been provided, the Fed unveiled, while Congress fights as usual, the Fed unveiled an unprecedented expansion to its mandate, announcing open-ended quantitative easing, which also gave it the mandate to buy corporate bonds, because everyone wants to be net sellers, and after they've already made money, already made commissions, and hedge funds have blown up, all the large risk parity hedge funds that have leveraged up their bond trades, and they all want out at the same time. Their risk officers are all telling them that they need to be massive net sellers and reduce their bond positions, including investment grade, by 90%. That's what a source told me who is friends with a very good professional bond fund manager who has a lot of assets under management, that he was told by his his bosses and his risk officer to reduce his bond holdings at his bond fund inside an investment bank down by 90%. Enormous net selling. So who's going to buy them? If everyone's trying to sell these things now, and everyone's worried about investment grade bonds being downgraded and losing value, who's going to buy them? Easy answer. If you're familiar with the financial markets now, it's the Fed. I actually just read interesting blog articles. I'll do this on another show about how the Fed is probably going to have to nationalize Fannie Mae and Freddie Mac now. So the fake GSEs and the problems in the mortgage finance industry are enormous again too. So I'll talk about that on another show. And also, it looks like the commercial real estate market is collapsing as well. So I'll talk about those on other shows. But nothing is off the table for the Fed to add to the balance sheet and to buy. I don't think we'll get to $47 trillion right away like Luke Groman is saying, but I would not be surprised if Kyle Bass is right and $6 trillion more is created maybe in a year or less. Maybe faster. Depends. I've seen Democrat politicians, Chris Martinson covered this on a recent video, where Democrat politicians were talking about how much cash MMTQE should be given to each family with a child, and the amount came out to like $6 trillion in a year or two. So it could happen. Of course, we're going to deal with a lot worse stagflation and then potentially even worse than that later on. Okay, back to the article. Announced open-ended QE, which also gave it the mandate to buy corporate bonds in the primary and secondary market to unclog the frozen corporate bond market because everyone wants to be net sellers and reduce their bond positions down enormously. Some of these firms want to reduce their bond positions by 90%. They were ordered to. These bond fund managers that were making a lot of money off leveraged bond trades, that trade is now going in reverse, and some of them have been ordered to reduce their bond exposure by 90%. Well, who's going to buy all these bonds? Frozen corporate bond market, as we just one step away from a full Fed nationalization of the market. Only Fed stock purchases remain now. As noted elsewhere, the Fed's new credit facilities carry limits on paying dividends and making stock buybacks for firms that defer interest payments but have no explicit restrictions preventing beneficiaries from laying off workers. Additionally, in addition to treasuries, the Fed will now buy agency commercial mortgage-backed securities, all in unlimited size. So those the people who either own homes are not making the payments. So now these mortgage-backed securities, very similarly to 2007 and 2008, where I've said at length with repo madness, when they were used as collateral, at one point for years they were good collateral, these mortgage-backed securities, and then in 2007 and 2008 they turned from good collateral into bad collateral. They turned from assets into toxic liabilities. Looks like the same thing is happening. This was predictable, but in between, a lot of banksters, a lot of hedge fund managers, a lot of people borrowed from the repo market that they shouldn't. The money market funds, a lot of them, unfortunately, loaned into the tri-party private repo market. Bank of New York Mellon was heavily involved in this as a custodian, and those hedge funds drastically over-leveraged. A lot of them were risk parity ones. The last month has been absolutely brutal for risk parity hedge funds, having lost, according to hedge fund manager Tavi Costa, who posted a chart on his Twitter in the last couple days, an average of 40% in only a month. So this was the worst month for hedge funds that own stocks, but hedge funds also got killed with the risk parity trade leveraging bonds, especially corporate bonds. Okay, in addition to treasuries of commercial and mortgage-backed securities, all in unlimited size, the Fed will buy treasuries and agency mortgage-backed securities in the amounts needed to support smooth market functioning and effective transmission of monetary policy to broader financial conditions in the economy. Also add to help devalue the dollar. And will also buy agency commercial mortgage-backed securities, according to a statement. The Fed also said it will support the flow of credit to employers, consumers, and businesses by establishing new programs that, taken together, will provide up to $300 billion in new financing. It will be backed by $30 billion from the Treasury's Exchange Stabilization Fund. Coincidentally, this unprecedented action takes place just hours after real estate billionaire Tom Barrack, and friend of Donald Trump, said the U.S. commercial mortgage market is on the brink of collapse and predicted a domino effect of catastrophic economic consequences if banks and government didn't take prompt action to keep borrowers from defaulting. Quote, loan repayment demands are likely to escalate on a systemic level, triggering a domino effect of borrower defaults that will swiftly and severely impact the broad range of stakeholders in the entire real estate market, including property, homeowners, landlords, developers, hotel operators, and their respective tenants and employees, he wrote. So this is starting to sound a lot like 1929. I know a lot of people are comparing what's happened now to 1987, but this reminds me a lot more of 1929, where it just keeps going down and there's false hope, and the central bank just keeps trying more and more. So historically, we're looking now at a lot of the same desperation from governments and central banks from the 1929 to 1937 period. And in 1934, what did FDR do? He devalued against gold. Now, FDR also did a lot of other crazy stuff, but he did the one thing that central bankers do not want, and Keynesians do not want to do. He devalued against gold. They tried everything else first, but then they devalued against gold. Okay, Barrack said the impact could dwarf that of the Great Depression of 1929, and now commercial mortgage-backed securities get their bailout. Wow, just wow, George Rusnak, head of investment management at Wells Fargo Private Bank, told Bloomberg Television. Hopefully you'll come out of this with some fiscal stimulus as well, and you'll be set with good growth opportunities in the long run. Also, let me add enormous amounts of more inflation, especially when things return to normal levels of velocity of money prior to the global pandemic. As I was explaining to the troll last night, there's an in-depth comment and analysis below that video, just totally debunking anything that troll said. When the banks when the banks had the reserve requirement ratio lowered to 0, he said that it's going to be guaranteed hyperinflationary immediately. No, it's not. There has to be velocity of money, lending and spending in the real economy first. Lending and spending in the real economy, other than people going to the grocery store or buying, cleaning supplies, or to Costco, or to buy, basic, prescriptions at the pharmacy. Lending and spending in the normal economy, normal business activity, has collapsed. And you see this in the oil market. You see this in a lot of other restaurants, consumer businesses, travel. It's all collapsed. And everyone's cash flow projections, which they had to have stable cash flow given their debt levels, all these companies, those are out the window too. That's why everyone's in trouble, because everyone took out all these accountants and chief financial officers, all took out their Excel spreadsheets, right? And they said that they can maintain these debt levels and the company would have okay credit ratings and okay ratios as long as their cash flows were stable. But guess what? Cash flows have collapsed. So now you're in trouble. That's why everyone is in big, big trouble. So we're in the process, and we're far from done, unless the Fed figures out the right combination of new press releases and guarantees and trillions more in promises. Maybe they buy up subprime auto loans and leverage loans and collateralized loan obligations and God knows what else. I would not be surprised if we saw press releases guaranteeing they buy all those too, and credit card debt, and maybe a large chunk or all student loan debt in the next... we'll see how low the stock market goes. Because the lower the stock market goes, and how the higher the dollar index stays, the more likely the Fed is to keep doing larger and crazier things. There, I think I said that right. But in a sign of just how unnerved investors are by the global pandemic, the Fed's move failed to spark anything beyond a brief rally in stocks and corporate bonds on Monday. Stocks fell around 1.5% after trading opened in New York. Yields on 10-year U.S. Treasuries initially sank, then soared after Mnuchin warned of a deluge of new issuance, and finally slumped again, trading at 0.73% last. Let me see here if the article was actually written before the markets closed. No, I don't know. The article wasn't written before the markets closed. The article was not written, after the markets closed. Naturally, Wall Street analysts habituated to getting a bailout anytime stocks dropped were delighted. This is a great step forward, said Julia Coronado, the president of Macro Policy Perspectives. The getting to the corporate bond market was critical. A lot of people needed to be clear the QE was unconstrained. Wow. Yep, so they're addicted to QE. The depression was about the Fed moving too slowly, said Neil Dutta, head of economics at Renaissance Macro Research in New York. The Fed moved too slowly. They were doing repo madness since September. It exploded. I mean, I think most of these hedge funds that blew up in the last 2 or 3 weeks, they were heavily crippled in September. And then they just trudged along, they limped along, they're basically dead the last 6 months, and the kill shot came in the last 2 or 3 weeks. They're not going to admit that, though. They're not going to admit that, okay, things really blew up 6 months ago, and we lied to everyone, and we let the repo go, and our tax collecting excuse, end of the quarter, blah blah blah. That wasn't true either. They're not going to admit that. Well, maybe in some books later. Maybe we'll get the truth in some books later. Probably not, though. Okay, the Fed also said it expects to announce soon the establishment of a Main Street business lending program to support lending to eligible small and medium-sized businesses, complementing efforts by the Small Business Administration. So Larry Kudlow has also said that those loans will be forgiven. I think also Neil Kashkari also said that on his 60 Minutes interview yesterday. So Larry Kudlow has referenced that small business loans will be issued and they will be forgiven. And then Neil Kashkari, the head of the Minneapolis Federal Reserve Bank, also said the same thing. And Larry Kudlow has said about the federal government also taking equity stakes in other companies. So I don't know if we got any details on that yet. I'm going to read more of this press release, but I would not be surprised to see something like AIG or some of the other equity stakes that the federal government, maybe Government Motors type of deal, that the federal government got in past financial crises. Federal Reserve announces extensive new measures to support the economy. Federal Reserve committed to use... Okay, this is the full details. Federal Reserve is committed to using its full range of tools to support households, businesses, and the U.S. economy overall in this challenging time. The global pandemic is causing, if I say that C word, they're going to demonetize it. They'll probably demonetize the video anyway, but at least I tried not to say it right. It's causing tremendous hardship across the United States and around the world. Our nation's first priority is to care for those afflicted and to limit the further spread of the global pandemic. Oh yeah, smash the like button. While great uncertainty remains, it has become clear that our economy will face severe disruptions. Aggressive efforts must be taken to hyperinflate the currency. Whoops, did I just say that out loud? Across the public and devalue the dollar and private sectors to limit the losses to jobs and incomes and to promote a swift recovery once the disruptions abate. The Federal Reserve's role is guided by its mandate from Congress to promote maximum employment and stable prices. Totally impossible mandates given the scenario we're in now and how many trillions the Fed is even thinking about. I think Kyle Bass is probably going to be right for at least the next year or two. If he's, let me put it this way, if Kyle Bass is wrong on that number of like 6 trillion, it's going to be way more. And oh man, it's going to be, I don't even want to think about how bad that's going to be. Along with its responsibility, I need some water. Along with its responsibilities to promote the stability of the financial system, in support of these goals, the Federal Reserve is using its full range of authorities and will blackmail Congress or lobby Congress to get new ones. Oh, I added that in. To provide powerful support for the flow of credit to American families and businesses. These actions include support for critical market functioning. The Federal Open Market Committee will purchase Treasury securities and agency mortgage-backed securities in the amounts needed to support smooth market functioning and effective transmission of monetary policy to broader financial conditions in the economy. The FOMC has previously announced it would purchase at least $500 billion of treasury securities, and at least $200 billion of mortgage-backed securities. In addition, the FOMC will include purchases of agency commercial mortgage-backed securities, its agency mortgage-backed security purchases. Oh, in its agency mortgage... Got tongue-tied. In its agency mortgage-backed security purchases. Supporting the flow of credit to employers, consumers, and businesses by establishing new programs that, taken together, will provide up to $300 billion in new financing. That's nowhere near what the economy was generating prior to the global pandemic. The Department of the Treasury, using the Exchange Stabilization Fund, will provide $30 billion in equity to these facilities. Establishment of 2 facilities to support credit to large employers: the primary market corporate credit facility for our new bond and loan issuance, and the secondary market corporate loan facility to provide liquidity for outstanding corporate bonds. Establishment of a 3rd facility, another alphabet soup one. Besides the term auction facility, the term asset-backed securities loan facility, a new one, TALF, to support the flow of credit to consumers and businesses. I've lost count of how many alphabet soup programs there are. There's at least 5 or 6. The TALF will enable the issuance of asset-backed securities backed by student loans, auto loans, credit card loans. Oh my god, this is so toxic. Did they mention leverage loans and collateralized loan obligations? No, they did not. Not this time. Loans guaranteed by Small Business Administration and certain other assets. Oh, it's probably so toxic they didn't even want to mention it. With the CLOs. I mean, if these investment bank bond portfolio managers and these hedge funds don't want to hold what's still investment grade corporate bonds, imagine how toxic these CLOs are now. I mean, they must be radioactive. Okay, back to the facilitating the flow of credit to municipalities by expanding the money market mutual fund liquidity facility. I say that 3 times fast. I will not do that on this podcast. To include a wider range of securities, including municipal variable rate demand notes and bank certificates of deposit. Facilitating the flow of credit to municipalities by expanding the commercial paper funding facility to include high-quality, tax-exempt commercial paper and as eligible securities. In addition, the pricing of the facility has been reduced. Okay, if you want to read the rest, the link will be in the information and description section. Okay, so they mentioned the primary dealer one, they mentioned the money market one, and the commercial paper. So there's a couple others. It's just nuts. Okay, so let me get to the Jim Bianco's analysis here. Okay, so Jim Bianco says, it is difficult to find a superlative to describe what the Fed announced this morning. At first blush, it looks like they are nationalizing financial markets, except for equities, which are stocks, and high-yield debt, which are junk bonds. This better work in stabilizing financial markets. This morning, the Fed announced many new measures aimed at supporting the economy and markets. One aspect of this announcement was an update to their Treasury and agency purchases. Roughly 1 week ago, they announced a Treasury and mortgage-backed security purchase program with the intent to buy $500 billion and $200 billion in securities, respectively. This morning, they said these purchases would be unlimited, essentially open-ended QE. For the time being, it appears the Fed will buy $75 billion of treasuries each day this week. Considering the Fed's treasury holdings currently stand at $2.48 trillion, another $375 billion in purchases amounts to a 15% increase in holdings of U.S. treasuries in just 1 week. Okay, he's going line by line through the press release here. So he's talking about subjective. Okay, he says we take, quote, subjective to reasonable prices to mean that if the market does not set bond prices where the Fed wants them, the Fed will announce what the price should be. They would then use their unlimited balance sheet to make that happen and manipulate bonds. U.S. government bonds. So this goes by the name yield curve control. I think the Bank of Japan does this. So this is even worse, even more draconian financial repression, along with the update because probably many more trillions are coming. Along with the update to Treasury and agency purchases, the Fed also announced the following measures. They will buy corporate bonds. They will buy corporate bond ETFs. Wow, in the special purpose vehicle. They dusted off the 2008 TALF program. Okay, so TALF was from 2008. This will allow them to purchase securities backed by credit card and auto loans. Oh, hold your nose. Oh, it's a dirty diaper. They expanded the money market facility to buy short-term munis. They are establishing a Main Street lending facility. The Fed says details will follow. The bottom line is we think HSBC's, this is Jim Bianco's final comments here. We think HSBC's Stephen Major got it exactly right on Bloomberg TV this morning. He suggested the handshake might be a thing of the past, and I don't know if this was a kind of a poor joke for the global pandemic. The world has permanently changed. Stop thinking about mean reversion. We are not going back. We are headed to a new reality. Markets understand this, and they are rapidly repricing to a post-global pandemic world at historic speed. Almost tricked me into saying that. This is causing all kinds of problems as the markets move on from the old pre-global pandemic reality. The Fed is attempting to stop this repricing from going any further. They essentially announced they are nationalizing the markets. They will set the price and provide the credit. They are hoping to stop the completion of the post-global pandemic repricing. Will these new measures work? Can the Fed stop the entire financial world from repricing to what it perceives as fair value? It is difficult, if not impossible, to know where the market sees fair value at this point. We believe these new Fed facilities will only work if the market is close to a perceived fair value level. If risk markets still see lower prices in a post-global pandemic world reality, then they will continue to head lower. The world has changed. If the Fed is trying to stop the market from reflecting this, it will not work. If the markets are close to what it deems fair value on risk markets, perhaps the Fed's announcements this morning will prove helpful. So, again, let's talk about financial history perspective. Reminds me a lot of after the aftermath of the 1929 stock market crash. Reminds me a lot of the aftermath of what the Weimar Republic central banker did, Rudy Havenstein, right? Rudy Havenstein did remember Germany then, the Weimar Republic, I'm not sure which one I'm pronouncing correctly, they had deflation. So there was a big bust first before the hyperinflation. So it looks like, again, inflation is, according to the Austrian School of Economics, Ludwig von Mises' definition, inflation is 100% government created. So the government, the central bank, all want lots more inflation. Welcome to dystopia. So, in the short term, stock markets may go lower. The Fed could issue new press releases almost every day. Maybe every day, Monday through Friday. We don't know. Maybe they suspend the accounting laws for these large corporations, similar to what happened with the large banks and the FASB. So the large corporations do not get those credit ratings downgrades. Maybe. We'll see. The situation is very fluid. It can change on a daily basis. This is how crazy everything is. People told me 2 weeks ago, a month ago, things are already crazy. And I told them things will get a lot crazier. And here we are in a full-blown crisis. The Fed's balance sheet is now way larger than 2008 and 2009. And it is far from finished. The printing of the trillions will go... The printing will go into the many trillions now. In fact, I would not be shocked if Kyle Bass is right and another $6 trillion is created in the next 12 months, give or take. The Fed's official balance sheet, and this is the crazy part, will be at around $10 trillion in 12 to 18 months. So the Fed's official balance sheet is at over 4.6 trillion now, almost 4.7 trillion. And if Kyle Bass is right, the Fed's official balance sheet in under 18 months will be at least $10 trillion. That's how crazy everything is. And that might not be enough. We're going to see. Okay, I will look at listener questions and comments. If there is any super chats, please hit the like button. I have almost 500 people watching and almost no likes. This is a good question from Francisco Alvarez. Can they print infinite money? In theory, yes. In reality, no. And this is the problem with PhD academics. They look at their models. They live in fantasy world. So they see that they're willing to do anything to get the dollar down. They're willing to do anything to get any type of economic activity back. And at some point, this is going to mean even worse inflation, and that genie will be out of the bottle. They will not be able to put it back. So no, they cannot create unlimited money, but the problem is we have all these central banks doing it. It's not just the Fed. But the main problem here is the dollar. Again, I talked about this the first week. So we have the bond markets and credit markets freezing up. There's too much debt. But the main problem is the dollar because of all the crazy stuff that's been going on with it since the 2008 financial crisis, and how much dollar-denominated debt foreign governments, foreign private banks, foreign private corporations all borrowed in dollars. So there's a ton of articles that have been coming out, a lot of financial professionals talking about this, saying that there's a $12 trillion margin call now. And that's because the global economy is not functioning normally. Americans, consumers, and American travelers are not going to other countries and spending their dollars there. They're not buying goods and services from people in other countries and sending their dollars there. When the global economy is functioning normally, dollars leave the U.S., and those companies or governments that borrowed in dollars, they can service their dollar-denominated debt all right. But now that the global economy is nowhere near levels prior to the global pandemic, now that dollar-denominated debt is defaulting. Now, here's the thing that most financial professionals miss. So they say it's a $12 trillion $12 trillion margin call. Zero Hedge has been running stories on this. I've been seeing financial professionals write articles on this. I've been seeing them do interviews on TV about this. I've been seeing them tweet about this. That's not the real number. The real number on this margin call, you have to add in the derivatives, the dollar liabilities. If you add in the derivatives too, which I'm sure are going bad now because the dollars are not coming in out, they're not going from the US consumer and US companies paying foreign companies and foreign governments. The trade's not functioning properly. So the real number for this margin call is at least 24 trillion. And how do I know this? Because back in December of 2019, the Bank of International Settlements, or BIS as everyone calls it, put out a global macro update. It was over 150 pages. I covered it a lot on my channel back then. And not only they spent over 24 pages of a 150-page report talking about these derivatives that had exploded in amount in only 3 or 4 years, called forward dollar swaps. And they said that the amount of them had just exploded in size. The Bank of International Settlements was terrified about dollar-denominated debt outstanding, which had doubled in size over the last 6 or 7 years, and forward dollar swaps, which had exploded in size. So to look at this margin call, how many people need dollars to deal with the dollar-denominated debt and the dollar liabilities, these derivatives? It's not 12 trillion on the margin call. There is at least 24 trillion in demand to prevent collapse. So the margin call is at least 24 trillion. People have the number wrong. They're wrong by a lot. And it's the Bank of International Settlements that had the number. They said that the derivatives for currency swap derivatives, which are almost all forward dollar swaps, I was covering this. I showed charts and graphs on this in the past. At least 11 trillion. So this margin call is absolutely enormous. The Fed is trying to weaken the dollar, trying to flood the economy with trying to flood the entire globe with dollars to prevent full defaults. And this is because all these foreign governments and foreign companies were all betting on a weak dollar. They were wrong, and when the global pandemic hit, they stopped getting paid in dollars and they started defaulting. And then you also have decline in demand for oil. That exacerbated the problem. So it's vicious cycle, doom, vortex loop of doom, whatever you want to call it. Okay, the margin call is at least twice the size of what people are claiming. But the Fed is not out of ammunition. They will do crazier and crazier stuff. They are aware of the derivatives. The Bank of International Settlements was writing extensive warnings. There was articles coming out from Olga Kotaga, 2 articles in 24 hours. I covered this. I don't think anyone else did. From Reuters in November 2019 about forward dollar swaps. They were extensive. And in my opinion, she was tipped. Some central banker, some hedge fund manager, someone told her to cover forward dollar swaps. They were important. So she spent a lot of time covering them in 24 hours. So not only is the dollar-denominated debt going bad, it's the forward dollar swaps. It's all these dollar liabilities together. The margin call is much larger than most people think, including most financial professionals. And this is why the Fed is one of the major reasons why the Fed is doing what it's doing. The Fed also wants, QE. Republicans and Democrats want people spending money into the economy. Look how quickly the Republicans caved. So there is a limit. We have not hit the limit. Francisco, sorry to go off on a little tangent there, but it was important to talk about. I wanted to talk about that earlier and I forgot. So it is important to talk about the forward dollar swaps, and there is a limit. We have not hit the limit yet on dollars. Spartacus asks, so where do millions of renters and homeowners go? I think they're getting their mortgages suspended for at least a couple months and rent may be frozen. They're talking about suspending people's credit ratings, stuff like that. They're changing the rules, man. I don't think they're going to be throwing people on the streets. People are going to be getting big checks, probably. Okay, I have a super chat from Sean Cole. Thank you, Sean, for the super chat. What does the currency swap lines do to the dollar's value? And he says he loves this channel. Okay, great. Thank you for saying you love this channel. I appreciate it. I work really hard to provide some of the best information, content, research, analysis, and financial education out there. And it's just me. It's just me, and I'm spending all this time lately, the last couple weeks, doing all this shopping for my parents so they can prep. It's because they didn't prepare for really anything. I did buy them some N95 masks over a month ago, and of course they refuse to wear them now, inside or outside the house. Okay, anyway. What does the currency swap lines do to the dollar's value? So, Brent Johnson, my friend Brent Johnson at Santiago Capital, he said that currency swaps actually create more demand for dollars because the currency swaps have to eventually be paid back. I'm going to slightly disagree with Brent there because I think currency swaps, the Fed can waive them. They're arbitrary. So the Fed doesn't need the other currency that's being swapped, and the Fed at its own discretion can just waive them. So don't bet if the currency swaps are issued more, if you see more press releases, don't bet on an immediate collapse of the dollar, and don't bet that it guarantees the dollar is going to rise more. I would say it's complicated. It depends what the Fed decides to do with the currency swaps, because if the Fed wants, they can really stick it to whoever borrows the currency swaps at very high penalty rates, or they can waive the fees. That's how crazy and arbitrary these currency swap lines are. So the Fed can literally say that, oh, we're friends with the Bank of Japan. We like those guys. And, we're going to give them trillions of dollars, and they're going to send us yen, but we don't need the yen. We're going to swap them. And we're going to give them trillions of dollars right now that their corporations, Toyota, Sony, Honda, all those guys didn't have to earn. And all of a sudden, they just decide, okay, we gave them those currencies. We helped out the Japanese banks. We helped out the Japanese corporations that borrowed too much in dollar-denominated debt, and the Japanese banks that have garbage CLOs that we also helped them out with and bought, and the Japanese banks that were playing, forward dollar swaps or whatever. And they just decide that, oh, we're going to, you know what? We like those guys. We like those guys. We have nice parties in Tokyo for a week or so, or we have really fun times at Davos or Jackson Hole, and we're just going to waive those fees for them. It's very arbitrary from what I've learned. So they can stick it. They can put very punitive borrowing costs on the currency swaps and force someone to try to pay it back, and it could get to like a country being forced to pay war reparations. They could do that in theory. And initially, the currency swaps, I think, were intended to do that. They were intended to be very punitive for borrowing like that. However, it seems like a lot of the stuff in 2008 and 9 was just waived. That a lot of the stuff was not paid back. So I think it's arbitrary. I don't see one guaranteed direction either way for the currency swaps, but the margin call is much larger. So we could see more swaps issued trying to deal with the margin call, the dollar margin call, and weaken the dollar. I got a super chat from Greg. Thank you, Greg. Greg says, another lap dance for me. No, I don't go to strip clubs and waste my money like that. But I appreciate you sending the money. Thank you, though. I don't waste my money like that. I didn't do that in college. I don't do that now. Okay, so let me take one more look, and then we're going to wrap stuff up here. Been talking for almost 50 minutes, and I'm starting to get a headache. And I need to go lift some weights. Okay, one more super chat from Abbey Road. Thank you for the super chat, Abby. She says that she's had the she had the virus. Oh, now the video is probably demonetized since I said one word. Whatever. She's had it. When you have had it, it is so bad you get 50 times more pessimistic. It feels like you're dying. You take an air and you feel no air at all. Well, apparently you survived it, right? So, congratulations, you survived it. Hopefully you don't have permanent lung damage. Maybe you should, I can't be a doctor here and give medical advice. I'm not a doctor. But I am dosing myself with some silver solution, and I haven't gotten sick yet, so I don't know. Maybe it'll work. They're sold out, though. I think a lot of the places are sold out now. Maybe that'll help. Okay, everyone. Well, thank you very much for listening, and there is a lot more content behind the paywall on Patreon, including a new update on some gold and silver stocks that people asked me for. People wanted some analysis and a list of the safer ones. I put that out. But I'm really wondering if the Fed is actually going to bail out all these restaurants and some of these others, because the companies, the stock charts are just looking really ugly. There's a restaurant in there. I just did some analysis on it a few hours ago. And this restaurant is now, they're so desperate for customers. They just maxed out their credit card, which is their revolving credit facility. They had very little cash on the balance sheet. And they're offering the items on their menu at less than 50% off. So we'll see if the Fed, who the Fed decides to bail out. Again, this is picking winners and losers. Government should not be able to do this. Central banks should not be able to do this. But I have no say in the matter. And the Fed is going to most likely print many, many trillions in the next 12 months.